Okay, Yannick, let's get into it. Nvidia just came off a record-breaking year. $130 billion in revenue, $115 billion of that from data center, and they're sitting on nearly $61 billion in free cash flow. They're rolling out Blackwell faster than anyone expected, and they're already guiding for $43 billion in Q1 revenue. I get the stock is expensive on paper, but with PEG under 0.6 and a forward PE around 23x, this feels like a generational entry point to me. Thoughts?
Well, you know me, Guillermo. I don't deny Nvidia's dominance, but the valuation still worries me. It's not just about PEG or PE. We're talking about a company trading at over 21 times sales. That's a lot of future growth priced in. And sure, the Blackwell ramp is happening, but it's also compressing margins. GAAP gross margins dropped from over 76% to 73%. Non-GAAP is still falling too. What if the best is already behind us?
But isn't that kind of the point? Even with those margin pressures, Nvidia still managed $22 billion in Q4 net income. The Blackwell ramp-up is expensive, but it's transitional. Colette Kress said margins should recover later in the year as volume scales. Plus, Nvidia's not just selling chips, they're selling a platform. CUDA, DGX, Spectrum X, NIM microservices. This isn't a fabless chip maker anymore, it's an AI infrastructure empire.
Okay, let's talk platform. Yes, CUDA is sticky. Yes, they've locked down the AI developer ecosystem, but 88% of their revenue is still coming from data center. That's a dangerous level of concentration. If the hyperscalers, AWS, Azure, GCP, slow AI infra spend, Nvidia gets hit hard. And these same customers are developing their own chips. Trainium, TPUs, Maya. Even Meta has their MTIA. That's not just noise.
Sure, they're all building in-house chips, but they still rely on Nvidia. In fact, most run Nvidia in tandem with their own silicon. Why? Because Nvidia works. They're the Swiss Army knife of AI. You want flexibility across models, compatibility across frameworks, ease of scaling. You use Nvidia. That's why their market share in AI accelerators is estimated between 80 to 95%.
Fair. But every monopoly starts looking invincible until it doesn't. Remember Intel? Dominated for years. Then AMD caught up. And look at AMD now. They've got Microsoft and Meta testing the MI300. ROCM is improving. MI325X is coming. And Nvidia's focus on data center has left openings in other markets. Their gaming GPU share slipped in Q4 because they prioritized Hopper and Blackwell production. That's smart, but also shows trade-offs.
Trade-offs, yes, but strategic ones. Gaming's still $11.4 billion in revenue, up 9% year over year. Automotive doubled to $1.7 billion. And then there's Omniverse, Isaac, Jetson. These are still small bets, but they show where the next frontier is. Nvidia is positioning itself to be more than the AI chip provider. They're building the operating system for AI across industries.
Maybe, but you can't ignore the risks. Geopolitically, the US-China tension is only getting worse. Export controls already cost Nvidia billions. Just look at the hit from the H20 ban in China. The company estimates $5.5 billion in potential revenue loss from that alone. If controls get tighter or tensions escalate further, boom, another chunk of addressable market disappears.
Totally valid. But again, that's baked into expectations. Analysts are cautious on China exposure now, and Nvidia has been proactively designing chips that comply with export rules while still performing competitively. Plus, the AI build-out isn't just a US-China thing. Europe, India, Middle East, Southeast Asia, they're all launching sovereign AI projects. The TAM is global.
I'll give you that. But I come back to growth rates. FY 2025 was a miracle year. Revenue up 114%, EPS up 147%. That's not repeatable. In Q1 fiscal year 2026, guidance is for 9.4% sequential growth. Still great, but clearly decelerating. The law of large numbers kicks in eventually. You can't grow triple digits forever.
Sure, but look at the comps. Microsoft trades at 33 times forward earnings. Nvidia is around 23x with higher expected earnings growth. The PEG ratio is arguably the most bullish signal here. And the market cap, $2.8 trillion, yes, it's huge. But it's also backed by $60+ billion in FCF and nearly $80 billion in equity. This isn't pure hype anymore.
Yet that's what worries me. It's not hype anymore, it's consensus. Everyone loves Nvidia. Analysts are still mostly bullish. When everyone agrees, that's when you want to start watching your back. The contrarian in me is twitching.
So what's the play then? Sit on the sidelines and hope for a crash?
Not necessarily a crash, just a reset. Maybe Blackwell margin pressure spooks the market. Maybe the next inflation print spooks tech. If Nvidia drops back under $100, I'm loading up. But I want a bit more air under me. I don't buy companies at peak optimism.
Fair, but here's the thing. When Nvidia dips, it gets bought fast. Look at post-GTC volatility. The market wants Nvidia exposure, so instead of waiting for the perfect price, I'd rather scale in. Dollar cost average. Own the leader in the biggest secular trend of our generation.
And that's valid. I mean, I'm not saying short the thing. Nvidia is a beast. It has a software moat, a hardware lead, and a visionary CEO. But from where I sit, the risks are rising faster than the reward. So I'm holding, not selling, but not adding either.
And I'm buying, not all at once, but building a position. Because companies like this, you don't get a lot of shots. The Blackwell ramp is just beginning. Rubin's on deck, software monetization is still early. And they're sitting on an AI war chest. For me, Nvidia still has room to run.
Then I guess we've got our positions. You're the AI optimist. I'm the cautious bull. Let's check back after Q1 earnings.
Deal. But don't be surprised if you see me with a few more NVDA shares by then.
Just make sure you save me a seat when the next dip comes.